Hello friends, today we are here to discuss revisions of FR in case 113 fair value. Let's start. Myself Dipesh Majithia, I'm from Bangalore. Shall we start? Now chartered, this AS has this structure. This is one of the most important AS, or rather I would say an AS, or rather an IND AS, which is used almost in all the standards, correct? Like all the standards are based on fair value, and how to calculate fair value, how to determine fair value is given in this standard, correct? So this standard basically prescribes principles for determination of fair value, which is used in other IND AS, except fair value of options, which is used in share based payments, fair value of asset, which is used in lease, and value in use, which we use in impairment. These three fair values are not covered over here. Rest anywhere, wherever fair value is used, that fair value is to be determined on the principles of this standard. Or let me put it other way. Every standard there is a fair value requirement. If that standard prescribes how to calculate fair value, very good. If that standard does not prescribe how to calculate fair value, then fair value is as per IND AS 113. Am I clear? So basically three standards gets excluded. First of all, fair value of option. How to calculate fair value of options is not there as a part of FR syllabus that you learn in AF. Fair value of lease calculation is given in lease chapter, lease IND AS only 116. And fair value or value in use, how to calculate that is given in IND AS 36 only, that is impairment, correct? Apart from this, how to determine the fair value, that is given in this standard. So first, this standard tells us what is the meaning of the fair value. It says the price that would be received to sell the asset, or the price that would be paid to transfer the liability. It is very simple to understand price which is received to sell the asset, but the price paid to transfer a liability. What does the word transfer a liability means? Exit price. Now suppose chartered, I have got a liability in my book. That liability I am supposed to pay it off, but that liability I give it to somebody else. That liability I give it to somebody else, and that person takes the responsibility of payment to the liability. Suppose in my books the liability is of 50,000. I tell him I am ready to give this liability to you at 49,000. He says done. So I have given him the liability for 49,000. So that means he will make sure that when he settles the liability, he settles it at a price lesser than 49,000. Therefore, he generates the profit. Correct. So transfer of a liability means the price to sell a liability to Mr. X, who will settle liability on our behalf in future. Am I clear? Sir, that means you are trying to say we can sell the liability? Yes, we can sell the liability. We can sell the asset, we can sell the liability. When we sell the liability, we have to make the payment. When we sell the asset, we receive the payment. Am I clear? So the standard says fair value is the price that would be received to sell the asset or paid to transfer the liability. This is also known as paid to transfer the liability, is also known as exit price chartered, correct? Now, paid to transfer a liability means what? It means price paid to sell the liability. That is price paid to Mr. X, who would in turn settle the liability in future. Am I clear? Yes, no. So there is a liability in my books. I said liability to bank. The price which I would pay today to settle the liability. Am I clear? That is known as price paid to transfer the liability or exit price. Now chartered, there are two ways to look at it. I want to exit from the liability. That means liability from my books should be derecognized. The price paid to derecognize a liability is known as exit price. Now suppose there is a liability in my books which is 5 lakhs, which I am supposed to pay in 3 years time. Fair enough. I tell him, if I pay you today, how much you will take? There is a price agreed between us and he says, Dipesh, I am ready to take 4,80,000. That means 4,80,000 is my exit price. So I will show that liability at exit price. That is the fair value of the liability. Or he says, no, I want 5 lakhs after 3 years only. So I catch hold of Mr. X and I tell him, this is the liability which I am supposed to settle after 3 years at 5 lakhs. What price you will take today? He said, okay, give me 4,90,000. So I give him 4,90,000 and the liability settles. So he invests 4,90,000 in such a way that he gets more than 5 lakhs and then after 3 years he settles the liability. That is his lookout. Am I clear? So price paid to transfer the liability is known as exit price. So we can say fair value of liability is little tricky. It is a price paid to transfer the liability. We can call it exit price or the price at which liability would be derecognized. That is not mentioned in this standard, but exit price is nothing but price paid to derecognize a liability. And transfer a liability means price paid to Mr. X, who will pay the liability on our behalf in future. Now chartered. So fair value is that price that would be received to sell the asset or paid to transfer a liability, an orderly transaction. Orderly transaction means transaction which takes place between two people without any force or coercion and between market participants, that is independent buyer and seller. There is no sort of relation. It should not be between related parties, independent buyers and sellers who can take decisions independently. So fair value is the price at which you can sell the asset or price paid to transfer a liability in an orderly transaction between market participants. Am I clear? So this is the definition which I have broken down. Now obviously, as I said, this entire standard deals with what? This entire standard deals with how to determine the fair value. Meaning of the fair value, bhai aapko samajh mein aa gaya, you understood. But how to determine the fair value, how to find out the fair value. Now chartered, the entire standards deals with that. Now let's understand. First preference is principal market. What is principal market? The market where there are a lot of buyers and a lot of sellers. If principal market is absent, then we can go to most advantageous market. What is the most advantageous market? Principal market where there are a lot of buyers, a lot of sellers. Most advantageous market basically is between two people. For example, I'll tell you, I've got a classroom. Correct? I've got a classroom. So basically it's a property. So property, I can sell it in the market where there are a lot of buyers and sellers. But classroom as it is would be sold at the best price if somebody is ready to buy it and use it as classroom only. Are you understand? Because benches are there, audio video systems are there, projector is there, board is there, laptop is there, software is there, everything is there. So whatever you require in the classroom, that is there. Will anybody else, there are so many market participants, if anybody else or randomly anybody from the market buys it, he would consider that as property. But if any teacher or schools or educational institute buys it, they would be ready to pay an extra amount. Why? Because they would use that as a classroom only. So that becomes the most advantageous market. So there is a big market where there are a lot of buyers and a lot of sellers. That is a principal market. Out of that principal market, there is a small market which is of educational institute, which would take my classroom as it is and would be ready to pay me little extra. That is most advantageous market. Correct? Second example, chartered, I have got a property. That means I am staying in a house. I have invested in a property. Say I am staying in Malleshwaram in Bangalore. Correct? That is say around 20 odd kilometers from Whitefield. Whitefield, may I have another house, investment purpose ke liye I purchased. Now my neighbor which stays over there is a nice guy, but his family was expanding. Correct? The kids were getting older rather, the kids were getting older and were in the age of getting married, so they were looking for an extra house. And they suddenly found out that Dipesh is ready to sell the house. I wanted to dispose the house, get the money and invest it or use it somewhere else. Where do I stay? Malleshwaram. Where do I have my investment? In Whitefield. The apartment in which I have an investment, there is a neighbor. That neighbor is looking for a house. and I want to sell the house. That house, so many people are ready to buy. So there are a lot of buyers and sellers. But my neighbor, exact adjacent neighbor, don't you think he will be ready to pay me little extra than the market price? Why? Because if he buys that house, no, he can just break a wall in between and create a huge flat. Are you understanding? Yes. Now, another example. JK classes is there on the second floor of a building, and I have a third floor. Correct? I have a third floor as an investment. Now I want to sell that. Don't you think when I'm ready to sell that, people are ready to pay me according to the market price? But JK Shah's classes would be ready to pay me little more than the market price because they would have extra classrooms in the same building. So that becomes the most advantageous market. So fair value should be determined firstly on the first preference on the basis of principal market. But if principal market does not exist, then on the basis of most advantageous market. Am I clear? Now, principal market is a market where a particular asset or liability is in highest volume. That means maximum number of buyers and sellers are there. How to find out the fair value? Listen, the price at which price of asset or liability in that principal market, less transportation cost incurred for bringing the asset to its present form to market. Am I clear? From its present form to market, that is transportation cost. All assets will not have a transportation cost. For example, immovable will not have a transportation cost, correct? Or if like some fixed plant and machinery, where people will come, look at the plant and machinery and pick it up from my place only. In such a situation, chartered transportation cost is not incurred. But generally, transportation cost will be incurred to bring the asset from its present location to market. Am I clear? So what is the fair value? Price of asset or liability less transportation cost incurred for bringing the asset or liability from its present location to market. That is fair value. So fair value is not the price at which it can be sold in the market. Fair value is the price at which it can be sold in the market less transportation cost incurred to bring the asset to the market. No, it can be sold in the market at 5 rupees, but the asset is there in my house. So if anybody purchases asset from my house, he will not purchase it for 5. He will say 1 rupees I am supposed to consider, 1 rupee I will consider to take the asset from your place to the market. Are you understanding? Yes or no? So he will deduct the carriage expenses which he is supposed to incur. So what we say, carriage expenses if we incur to bring the asset to market, so we can sell the asset in the market at 5 rupees. But for that we need to bring the asset to the market. To bring the asset to market we will incur 1 rupee. So ultimately market price for us is how much? 4 rupees. That is the fair value of the asset. But if principal market is not there, then we go to most advantageous market. Most advantageous market is net amount received from the sale of asset is maximum, or net amount paid to transfer a liability is minimum. Most advantageous, that means I will get the highest price or I have to pay the lowest price. Now how to calculate that? Price of asset or liability, most advantageous market ka less transportation cost, less transaction cost, is the net amount received or paid. Am I clear? I hope you understand. In case of fair value, it is price less transportation cost. In case of most advantageous, it is price less transportation cost will give you fair value, less transaction cost will give you net amount received or paid. Transaction cost includes commission, brokerage, taxes and duties, fees paid to regulatory authority or auctioneer's fees. Does not include income tax, finance cost and transportation cost. Right? Transportation cost is already considered while calculating the fair value. Am I clear? So what is the most advantageous market? Most advantageous market is the market where net amount received on sale of asset is maximum, or net amount paid to transfer the liability is minimum. So in case of most advantageous market, they are talking about not the fair value, they are talking about net amount paid or received. But in case of principal market, they are talking about fair value. What is fair value? Price minus transportation cost. And what is amount paid or received? That is fair value minus transaction cost. And what is transaction cost? Commission, brokerage, taxes, duties, fees paid to regulatory authority or auctioneer's fees. Does not include income tax, finance cost and transportation cost. Am I clear? So, determination of fair value while measuring the fair value. While measuring the fair value chartered, it is assumed that transaction cost to sell the asset or transfer the liability takes place in first preference, principal market. It is the market in which a particular asset or liability is in the highest volume. That is price of asset or liability less transportation cost to transport asset from its current location to market. That is known as fair value. उसके बाद चार्टेड मोस्ट एडवांटेजियस मार्केट क्या होता है? इट इज द मार्केट इन विच नेट अमाउंट रिसीव्ड ऑन सेल ऑफ एसेट इज मैक्सिमम और नेट अमाउंट पेड for liability is minimum. That is price, that is net amount paid, that is price of asset or liability less transportation cost gives you fair value less transaction cost is equal to net amount received or paid. Now chartered, but in both the cases you require price. How to determine the price chartered? In both the cases you require price. How to determine the price? Standard says price can be determined using the following inputs in the order, that is level 1, level 2, level 3. Level 1 is the quoted market price, the price at which it can be sold, the price at which it can be purchased. That is the quoted market price only is the fair value. Now chartered, level 2 mein price means quoted market price less add or subtract or adjusted with observable inputs. Now understand what does it say. It says first case में level 1 में it is quoted market price, so price in the market. Level 2 में it states that quoted market price adjusted with observable inputs. Observable input means those inputs which can be seen by everybody, which can be seen and which is known, which can be seen and which is known. There is no estimation, it is exact. This adjusted means it can be either added or subtracted. Correct? So level 2 mein chartered quoted market price, price means quoted market price. Level 2 में price means quoted market price adjusted with observable inputs. And level 3 में chartered, price is equal to quoted market price adjusted with unobservable inputs. So if I ask you what is fair value, the price at which the asset can be sold or liability can be transferred, less transportation cost incurred to bring the asset to market. Am I clear? Most advantageous में price for asset or liability, less transportation cost will give you fair value, less transaction cost will give you net amount paid or received. How do we calculate the price? Price, the standard that says can be calculated in 3 ways. Way 1, level 1, market में जाइए, what is the price? Correct? Now I'll give you an example. Now chartered, level 1, I want to purchase this pen. This pen is for 100 rupees. This pen is for 100 rupees. I go to the market, it is available for 100 rupees. If I buy it 100 rupees for you, if you buy it 100 rupees, anybody buys it, it is 100 rupees. That is the quoted market price. Khatam, I go to the market. Yes. And I say I want to buy 10 such pens or 12 such pens. एक dozen pen चाहिए. So one pen is how much? 100 rupees. So dozen means 12. 12 into 100 is how much? 1200 I am supposed to pay. So obviously, being an Indian, I will say, sahi daam lagao, tell me the correct price, because if I want to buy 12, I will not pay 1200, give me some discount for bulk purchases. He says, ठीक है दादा, you give me 10% discount. So he gives it to me at 1200 less 10% discount, that is 1080. Are you understanding? The price was how much? 1200. He is ready to give me at what price? 1200 minus 10%, that is 1080. This 1080 is a special discount to me or for anybody who buys it in bulk? Sir, anybody who buys it in bulk. So this is bulk discount. It is known discount. It is available to everybody who buys it in bulk. Yes? No? Yes. So that is known as observable input, level 2 price. Am I clear? That means bulk discount. Employee discount you must have seen. Employees, if I go to Titan, if I go to Apple, no, the person, salesman को मैं बोलता है, what's the price? He says 1 lakh. हमला some discount, हमला no discount. हमला some employee discount would be there, transfer it to me. Correct? No? So employee discount. Then chartered inflation adjustment. For example, market price, today I don't know, but I came to know this 6 months back, the same property was sold for, I've got a property of 3 crores, I believe. But if somebody asks me, Dipesh, how did you come to this price? I tell you, 2.5 crores, same property which I have, same locality, same design, everything same is sold for 2.5 crores. 2.5 crores. Correct? Now, 6 months mein 5% property price would have gone up, inflation. Just random I am taking. So 2.5 plus 0.25, that means 2.75 crores is the value of my property. Are you understanding? That means I am adjusting with inflation. Correct? फिर I went to purchase a car. Car ka price he told me 5 lakhs. Everybody ko 5 lakhs. But I told carman I want this extra, that extra, this extra, that extra. Correct? That what you call as accessories. So specification ke hisab se I put accessories, and accessories would cost extra. So that price, one is on-road price for me, you, everything is same. Say 5 lakhs. But for accessories and specification, they charge 25,000 extra for me. So for me, that car becomes how much? 5 lakh 25. That is for me specifically, for anybody, sir. So that is known as observable inputs, which anybody can see, observe, and it is known to everybody. It is not a hidden truth. Am I clear? That is level 2. So I can say level 1, एक पेन खरीदना था 120, level 2 12 पेन्स खरीदना था, but I got it not for 1200, but I got it for 1080 bulk discount. Level 3, I go to my friend, मैंने कहा कितने का? मतलब 1200. मैंने कहा दोस्त है दिपेश, you take it for 1000 rupees. So 200 rupees discount he gave me. Is it known to everybody? No. This is dosti discount, friendship discount. This is unobservable input. Am I clear? Or how do you determine the price of the asset? I thought this pen say I will teach 10 students in 1 year. I will teach, this pen will last for 3 years. So 10 students say this much fee. Next year 10 students say fees would be little more. Third year mein those 10 students say fee would be little. So these would be the cash flows. The rate of interest is this much in the market. So present value of cash flows I find out. Are those estimated or actual? Estimated. Known or unknown? Unknown. That is also known as unobservable inputs. Am I clear? So I repeat again. What is fair value? Fair value is the price at which the asset can be sold. Liabilities can be paid off less transportation cost incurred to bring the asset to the market. From that, if we subtract transaction cost, we get net amount paid or received. But how to find out the price charted? Correct. How to find out the price? Price find out करने के लिए we have to go to the market. Market में the quoted price पर if we record it, that is level 1 input. If we record it at quoted price adjusted with observable inputs, level 2 price. If quoted price is adjusted with unobservable inputs, then it is level 3 price. Am I clear? Yes or no? Yes, sir. So ये तो हो गया price, quoted market price. That means the price which is quoted in the market. But everything will have a market. Will all assets and liabilities have a market? No. So there can be a situation chartered, see यहाँ पर लिखा हुआ है, price is equal to quoted market price, that is principal price or exit price. Level 2, quoted market price adjusted with observable inputs. Observable inputs mean those inputs which are known for assets, for liability. Level 3, quoted market price is calculated using unobservable inputs, means price based on assumption and forecast of an entity. That is present value of future cash flows or those three discount. Correct? A related party discount. Determination of quoted price. If quoted price is not given, then fair value. If quoted price is given, then you are in this, life is settled. So you first find out quoted price say you can find out the fair value. So quoted price minus the transaction cost. But if quoted price is not there, you cannot find out the fair value. Then what will you do? Then chartered, if quoted price is not available, then fair value should be decided as under. Fair value should be decided as under. For non-financial assets, for financial assets, for liabilities, provision for DSR. Now chartered, what is? But this should be used only if quoted price is not available. Quoted price is not available, that means there is no principal market. For non-financial asset, market price is and the most advantageous price. That is a price basically between two parties. That is the most advantageous price. So that will become the fair value. Now chartered, for example, I'll tell you, I want to sell gold in Dubai. Correct? I'll get the maximum price, most advantageous price. But is it government? Does it government allow me to take gold and sell there? No. So legally not permissible. It should be legally permissible, financially viable and physically possible. Government is allowing? Yes. Physically, can you take 10 tons of gold? No. So it is physically not possible. So it should be legally permissible, financially liable and physically possible. So, but instead of 1 ton, I have got 2 kgs. Government is allowing? Yes. Physically possible? Yes. Financially viable? Yes, because that gives the maximum price. Then that would become the most advantageous price. Am I clear? If I sell it in India, I am getting 10 rupees. But if I go and sell it in Dubai, I'll get 12 rupees. So can I say Dubai is the most advantageous price? And can I consider that as my quoted price or fair value? No. Most advantageous price which satisfies the 3 conditions. Most advantageous price in India is 10 rupees. Most advantageous price in Dubai is 12 rupees. But Dubai, legally it is not possible. So can I say my fair value is 12 rupees? No. Then I have to say my fair value is 10 rupees only. Am I clear? Yes. For non-financial asset, market price of the most advantageous market, that is the highest price and the best use. For example, I told you about classroom. Correct? Yes? No? Yes, sir. Now chartered, I have got this tablet. Can you see where I write? Now this tablet where I am writing, that tablet has to be used with laptop. Correct? Now chartered, this tablet can be used by so many people. Some people might use it as a notice board. Some people might use it to in the conference room where directors would explain the things. Correct? In the conference room for explanation purpose, for presentation purpose. Artists can use it very nicely. Teachers can use it very nicely. So there is a market where a lot of buyers and sellers can be there. But don't you think artists and teachers would be ready to pay me little extra for this? That is most advantageous price, highest price, best use, provided it is legally permissible, financially viable and physically possible. Correct? Now for as far as financial asset like debtors, investment in debentures, loan, the price at which I can sell. Fair value is the transfer price, the price at which somebody is ready to buy. That is my fair value. So over here, if you remember, fair value ka definition you had studied in AS was, fair value is the price at which the asset can be sold or liability can be paid off between two knowledgeable parties at arm's length distance. So over here, in such case, if I have got debtors of 10,000 and I factor it, I sell it. He says, okay, 10,000 ka debtors, I am ready to give you 9,500. So that debtors does not have a market. So that is a price decided between two people. Then that becomes a fair value of non-financial asset. For liability, liability is the exit price, the price at which I can de-recognize the liability. That means I sit with the person and ask him how much you are ready to take today. He tells Dipesh, I am ready to take X rupees today and settle the liability. Then that X rupees becomes a fair value. Correct? Now, the liabilities are of two types. Liability amount and period is fixed. After 5 years, I am supposed to pay 5 lakhs. Then the present value of that is your liability is your fair value. But if the amount and the period is not fixed, then the price at which you can transfer means the person who is ready to take the responsibility of settling the liability in future on your behalf. Are you understanding? For liability chartered, ध्यान से देखो, for liability क्या होगा? I want to de-recognize liability के लिए exit price. Now, time period fixed, then present value of liability is my fair value. Time period not fixed. Time period not fixed. Then transfer price. What is the transfer price? The price at which price paid to transfer the liabilities. Price paid to transfer the liability. That means somebody else I am transferring the liability and giving him a payment now. So I de-recognize the liability from my books today. I gave the payment and that person will settle the liability in future. Am I clear? Yes, no. So time period is fixed, time period is not fixed. Now chartered. Correct? Now, provision for DSR and equitically have to wait. So you understood how to, if quoted price is not available, then fair value for non-financial asset is the price most advantageous, market price. For financial asset, the price at which you can sell the asset. For liability, if the time period is fixed, then present value of the liability. If time period is not fixed, then the transfer price. Am I clear? Equity and provision for DSR wait ಮಾಡಿ. Am I clear? To wait. Now chartered. Determination of fair value in equity shares. How to determine the fair value of investment in equity shares? How to determine the fair value of investment in equity? Equity shares, तो equity का value तो निकालना होगा. There are, तो step 1 में you are supposed to calculate the enterprise value, business का value. Then you are supposed to calculate the share value. And then you are supposed to calculate your investment ka value. Am I clear? So 3 stages. First you calculate the value of the business, then you calculate the value of share, and then you calculate the value of your investment. Now, to calculate enterprise value or the value of business, there are 3 ways: market price, income approach, and net assets approach. Market price approach, this valuation is very, very popular. Number of times EBITDA. So you must have heard Shark Tank mein or in the valuation, now you are going to office, you must have heard so many times that X Limited took over Y Limited. किस valuation में खरीदा? तो generally it is said 5 times EBITDA दिया, 5 times profit. So profit means EBITDA, earning before interest, tax, depreciation and amortization. Earning before interest, tax, depreciation and amortization. Number of times, 5 times EBITDA. This number of times into EBITDA is nothing but your P ratio. Oh. ध्यान से सोचो, EPS, MPS by EPS. Correct. Number of times EBITDA. Correct. Income approach. Present value, income approach, present value of future cash flows. Whatever cash income approach means cash income approach. Present value of future cash flows. ठीक है. Increase in the fair value of asset. Revaluation reserve wala, that is also my income. Correct. The present money which I have in my pocket. Correct. From that, whatever debts I am supposed to pay. So whatever I am supposed to receive, uska present value. Second, increase in the value of asset. Correct. Then chartered whatever cash and cash equivalent I have. So 10 rupees I am going to receive, उसका present value 8 rupees, ठीक है. Asset will increase by 3 rupees, so 8 plus 3 11. 2 rupees is presently there in my cash box, so it is 11. 13 rupees is the total cash and cash equivalent I have. Are you understanding? I am going to receive 10, उसका present value, so today I will receive 8, ठीक है. Then charted by increase in the value of asset 3 rupees. So 8 plus 3 11. 2 rupees is there in the cash book, 13. That 13 means I am supposed to pay debts of 5 rupees. So what is the enterprise value? 8 rupees. Am I clear? Yes, sir. Net asset approach. This to everybody knows, assets minus fair value of net assets minus fair value of liability. In any which ways chartered, you can find out the value of enterprise. Correct? Number of times EBITDA. Income approach. Over here, you are not taking profit element into consideration. So some people call this as revenue approach. When you say future, this is dangerous. Present value of future cash flow. That means as soon as you say present value of future cash flows, no, ये सुनने में बहुत आसान लगता है. But whatever you are trying to say, no, present value of future cash flows, that means you are supposed to assume the growth rate, inflation rate, increase in fees. So suppose I say I have got 10,000 students and I am collecting 50,000 rupees. Next year there will be 11,000. Next to next year there will be 12,000 students. So growth rate you are supposed to assume. Increase in fees rate you are supposed to assume. Are you understanding? So this present value of future cash flows is not an easy approach, income approach, which is popularly known as in the market as revenue approach. सब लोग बोलते हैं revenue पे खरीद लिया, profit is no meaning. ये वही वाला है. Correct? Over here profit per valuation, over here revenue per valuation, over here assets minus liability. So basically, if it's a business model which is asset incentive, this is more popular. If there is a business which is asset light model, a technology based model, like Ola hai, Uber hai, Lenskart hai, they are asset light model. उसके लिए this or this is more appropriate. Am I clear? I would always prefer, but who am I to tell you? But this is always better because you are running on profits. This is a sound valuation approach. This is a long-term positive value wala approach. Any which ways, after you find out the enterprise value chartered, total enterprise value divided by number of equity shares, will you get value of each equity share. ठीक है. Value of investment. Suppose enterprise value is 5,000. Enterprise value is 5,000. Correct? Enterprise value is 5,000. I have got 30% stake. So 30% means 1,500. Correct? अब imagine करो. Understand this. Suppose राकेश झुंझुनवाला के पास बहुत सारे शेयर्स है टाइटन के. Can he go to the Zerodha app and download all his shares? बेच देगा मार्केट में one shot? No, not possible. As soon as he starts selling, those who are into the market, if I've got 5 shares and I say sell 5, it does not happen that in fraction all the 5 shares will be sold. There is a market price 5 rupees. I have offered my shares, 5 shares at 5 rupees. Some people will be ready to buy. So one share is sold at 5 rupees. The market price falls. Again, 2 shares are sold at 4.5. Again, market price falls. 2 shares are sold at 4 rupees. So it's not mandatory at whatever price you sell. You see the market price and you press sell button. When you say market price, that means if the market price keeps on falling, 5 shares you have offered at market price. So same price, if one is sold, only one will be sold. There should be buyer also on the other side. Correct. So one is sold, then the market price falls. But I had told market price, so market price keeps on falling. So my market price keeps on changing. So can Mr. Damani, can Mr. Ramdev Agarwal, can Mr. any big investor for that matter, sell all one company ka shares which is held in lakhs and crores of shares? Can they sell it in a platform like Zerodha in one go? No. So they have to do these deals outside the market, bulk deals which you call it. So उसके लिए मुझे If the market price is 10 rupees, I will be able to sell at 8 rupees. 20% market price discount dena hoga. Similarly, when I do bulk deals in purchase also, I get 20% discount. Are you understanding? So 1500 minus liquidating discount, because I cannot sell it in the market, I am selling it outside the market. Less NCI discount. This value of enterprise has value of control also. When I buy the entire 100%, this enterprise means full enterprise. I don't have only share in assets and liabilities, I've got control also. But if I'm buying 30%, do I get control? No. So non-controlling discount with the dinner, I'm not getting control. So I'm not getting control. So uska 5% discount do. That is 75. So 1425 mein is the value of investment. So when I'm finding out the enterprise value, chartered enterprise value includes control valuation. So when I'm selling my investment, whatever is my 30% investment, enterprise value ke hisab se it is showing 1500. But will I get 1500? No, there will be two discounts. One is liquidating discount and one is NCI discount. Am I clear? Liquidating discount, because that is definitely not so less shares which I can trade in the market. Correct? So I will do a bulk deal outside. So outside I will not get the market price, I will get little lesser than the market price. Am I clear? Plus, if I take the enterprise value, obviously it has a controlling interest, but I am not selling the control. So non-controlling discount within a hunger. So both that discount I have to subtract, and whatever value I get, that is my value of investment. So over here, chartered, we learned how to calculate value of equity and value of investment in equity. This is basically value of equity. This is the basically value of equity. This is the value of equity share. And this is the value of investment in equity shares. So basically, step 1 gives you value of equity, that is business. Step 2 gives you value of equity share. And step 3 gives you value of investment in equity shares. Am I clear? Now chartered. So this you understood. If fair value, if quoted price is not available, then how do you find out the fair value? In first, for non-financial asset, most advantageous. For financial asset, the price at which you can sell. Price at which you can sell 1-to-1 basis. Whatever price may you are able to sell, that is your fair value. For liability, the price, exit price, derecognized price. If the time period is fixed, then present value. If time period is not fixed, then the price at which you can again transfer. Correct? Now chartered, equity. Equity ka price you have done. Now there is one special case, that is fair value of DSR liability. Now chartered, what is DSR? Now present value of decommissioning and site restoration. Decommissioning means removal of the asset, cost of removing the asset in the future, and site restoration means bringing the site to its original form. Correct? Suppose I have taken an asset on lease. Now lease mein I will show it as right to use, but I am supposed to return the asset after 10 years. So 10 years के बाद 10 years के लिए when I was using, no, तो I had created partitions on walls, POP ये सब create किया था. That all I have to remove. That is decommissioning. And chartered coloring करके wherever holes were there, वो सब ठीक करके I am supposed to give the site, that is site restoration cost. This I will incur today or after 10 years. After 10 years, so I have taken an asset on lease for 10 years. So I will show it in my balance sheet as ROU. That property I had created, done a POP, then electricity wiring I had done, then I had created walls. Correct? And because of all this, lot of holes I had made, then I had put so many electricity boards. Uske liye so many walls were damaged. Correct? Now when I am going, I don't have to only remove the assets, that is decommissioning, but I have to bring the site to its original form. The site, original form, the form which I saw when I purchased it or took it on lease. So that is known as decommissioning and site restoration. This we study in PPE. Now this cost I am supposed to incur after 10 years. So 10 years ke baad I thought I will incur 3 lakhs. Its present value is 1,20,000. Discount kiya to present value 1,20,000. So my balance sheet is appearing at 1,20,000. Correct today. But tell me honestly, How can I exit this? Is time is fixed? Yes. But the amount is fixed? No. Can I find out the present value? I found out the present value and recorded it. But ध्यान से सोचो, if I want to exit from this liability today, if I want to exit from this liability today, can I exit? No. I have to wait for 10 years. Now I got hold of a person. I told him, this is the scene. He told, okay. So he is ready to buy this liability. So I have to give him the money. He will take the responsibilities. After 10 years, he will incur decommissioning and site restoration and give it to the landlord. Are you understanding? Yes. How much he will charge from me? He will charge from me 1,20,000. No. He will charge from me whatever cost he is expecting to incur today. Today he is expecting to incur, say suppose, it does all the calculation and finds out expected to incur today. How much? 80,000. But 80,000 के बाद भी तो रिस्क तो है ना. So he says भाई 10% तो मैं रिस्क का जोड़ देता हूँ. 88 may be flawed. प्लस मैं 12,000 जोड़ देता हूँ because of inflation the price will increase. Correct? So this is the price which is expected to incur today including inflation. But this is the price today, risk premium today. Inflation जैसे adjust के it went tomorrow. उसका present value. So plus risk for 88,000 plus profit 12,000. Inflation के साथ जो adjust करना होगा. Say suppose he considers 24,000 inflation. So this is the cost he will incur after n years. उसका present value निकालेगा and that money he will ask from me. Are you understanding? So cost incurred plus risk premium, that his estimation can be wrong, plus his profit margin. Then he will adjust it to inflation, go to future. That would be the cost he will incur. Find out its present value today. And that much money he will ask from me. Now read, you will understand. If reporting entity transfers DSR liability to market participant, then market participant would calculate expected price to receive from the entity today so that he can discharge DSR liability in future with some profit in his hand. So how we will calculate? That is present value of inflation adjusted, expected cost to be incurred today plus profit plus premium. Now देखो, calculation of expected cost today, expected material, expected labor, expected allocated cost, that is your alpha, plus profit margin. This is real cash flows. That if he incurs the expenses today along with his profit, this is the real cash flows today. Calculation of as expected cost at the end of year end, that means after. This is the cost to be incurred today, but he will not incur it today. He will incur it after 10 years. So calculation of expected cost at the end of year N when DSR is to be incurred. That is inflation adjusted. Inflation adjusted cash flows is equal to real cash flows into 1 plus inflation rate to the power N. Inflation rate to the power N plus risk premium. Plus risk premium. Risk premium मतलब देखो what he did, he thought if I spend today I will spend 80,000 and I want a profit of 20,000. So today if I spend it would be 1 lakh, which after 10 years if I spend would be say 10 lakhs. 10 lakhs expected है, 2 lakh रुपया. Maybe my estimation went wrong. So 12 lakh rupees I will spend. So 12 lakh rupees I will spend. Therefore, inflation adjusted cash flows is today's cash flows plus 1 plus inflation rate to the power N. That will give you the amount which you are expecting to spend after 10 years plus risk premium. Risk premium is if your estimation is wrong to the extent, so you adjusted with risk premium. Step 3, price to be charged today, that is fair value. कैसे निकलेगा? Present value of present value of adjusted cash flows. Present value of adjusted cash flows. That means you have found out that how much you will incur that time. You adjust it today using risk-free rate plus risk percentage. What rate you will use? Risk-free rate plus risk percentage. Risk-free rate is 10%. But since you are taking risk, your risk value is 2%. So 12% may you discount it. Am I clear? Very logical it is. Very, very logical. So, if you ask me, how does this standard go about? Very, very important standard. If you know the flow of the standard, this standard objective is help you to calculate fair value. So, first they define the meaning of the fair value. They then tell you how to decide fair value with primary market, with principal market, without principal market. This is most advantageous. To determine the fair value, you require price. How to find out the price? Price is dependent on three levels: level 1, level 2, level 3. That is quoted price adjusted with observable inputs, quoted price adjusted with unobservable inputs. But if quoted price is not available, then how do you determine the fair value? For asset, for liability, for equity. Asset means though financial, non-financial. If you want, you can take the pick. You will get the flow of this. For asset, for financial, for non-financial, for liability, other liability, provision for DSR, and for equity. Step 1, enterprise value. Step 2, chartered is equity share ka value. Step 3, chartered is the value of investment in equity shares. Oh, so if you ask me broadly, quoted price is there, quoted price is not there. First you decide the quoted price. After you decide the quoted price, correct, you know the quoted price, then you find out the price. Price is nothing but quoted price adjusted with observable or unobservable. So first quoted price, then price, then fair value, then net amount paid or received. Okay, quoted price. So one flow is quoted price. Quoted price in three ways. Sorry, quoted price, then price three ways: quoted price or quoted price minus adjusted observable, adjusted non-observable. Price aa gaya. So first is quoted price, second is price, third is fair value, and fourth is net amount paid or received. Quoted price is the market price. Price is equal to quoted price adjusted. Fair value is equal to price less transportation cost. Correct? Fair value minus transaction cost gives you amount to be received or paid. Am I clear? But if quoted price is not available, then what? For non-financial asset, for financial asset, for liability, for provision for DSR, and for equity. Am I clear, chartered? So this is the flow of the standard. If this is clear, no, you will feel that fair value, everybody knows the meaning of fair value, but I feel that flow is missing in this standard. But I hope that I was able to give you that flow of this standard. Am I clear? Thank you so much. See you in the next standard. Next video with the next standard. Till then, take care. Goodbye.